Some investors don't really care about share price appreciation and only invest for the cash flow, which is fine. But if you're not one of those people and it's important for you to see your stocks go up in value along with the dividends, then listen up, because in this video we're talking about 4 stocks pegged by Wall Street analysts to see the most upside potential, which could mean big profits in your near future. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if that's up your alley and if you are on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Now, just as a quick disclaimer before we get into these 4 stocks, please guys, don't take these Wall Street analyst ratings as gospel. Just because they say a stock has some crazy upside potential does not mean it's guaranteed to play out that way. And I know for many of us here this goes without saying, but still I think it's important to mention because it's easy to look at these ratings and just start seeing dollar signs, but I know we're better than that, guys. Now, getting into the first stock, guys, this one is going to be Intuit, ticker symbol INTU, which I'm sure you're pretty familiar with. This is a software company that has 2 very popular, very sticky products, QuickBooks and TurboTax. Intuit also owns MailChimp, which is what I use for my weekly investing newsletter, and if you guys are not signed up for that yet, there's a link to it in the description if you want to check it out. Anyway, Wall Street analysts are currently giving Intuit a low price target of $360 per share, which is about 10% lower than where the stock's priced at today. They give it a high price target of $650 per share, and that leaves us with an average of $521.50, which represents a 27.25% upside. Now, so far this year, Intuit is down about 35%, but if we zoom out over a longer period of time, the stock has done really well across the last 5 years, where they're up 163.3%. And if we take a look at the PE ratio there over on the right, it's sitting at 28.88, which is kind of high and does not necessarily scream discount, but it also doesn't scare me away as much as you might think, because this company is still seeing a lot of growth. Going over to the income statement, we can see that Intuit has grown their revenues pretty aggressively across these last 10 years. I mean, they've pretty much quadrupled it from 2013 until now. Now, scrolling down to the bottom and taking a look at the earnings per share across time, guys, if we pull up this chart, we can see that there's been some nice growth on the bottom line here as well. And while we're here taking a look at the shares outstanding, this has been pretty flat across the last 10 years, guys, which is okay, because as we've seen, this stock tends to trade at a pretty hefty premium, so it might be a good thing that they're not buying back shares right now. Now, here on the balance sheet, taking a look at a couple more metrics, the book value per share of Intuit is climbing quite tremendously. At least since 2017, they've seen pretty aggressive growth in the book value. And now looking at the debt, this has gone from being negative to positive with about $4.2 billion of net debt as of their last quarterly earnings report, which over here on the statement of cash flows now we can see wouldn't be too hard to get rid of, seeing as they did about $3.4 billion in levered free cash flow just in the trailing 12 months. And if we pull up this chart right here, this is increasing quite steadily over time, which is fantastic and indicates that they will have no problem continuing to not only pay the dividend, but grow it, which they've done so far at a pretty aggressive rate. Across the last 5 years, Intuit has grown their dividend by an average of just under 15%, which is nothing to turn your nose up at and is refreshing to see considering they have such a low dividend yield, less than 1%. But still, the other dividend stats are looking good. They have a nice low payout ratio, just under 23%, and a decent dividend growth history of 10 years. So there is some consistency in the growth department here. Now, moving on to the next stock, this was one that I actually hadn't heard of before, Air Lease Corporation, ticker symbol AL, which is a company that buys commercial airplanes and leases them to different airlines all around the world. Some of their customers here just in the United States are Southwest Airlines, Allegiant, Alaskan, Delta, United, pretty much all of the big ones. And as we can see here, this stock is poised to have a bit more upside potential than Intuit. With an average price target of $54.86, Wall Street analysts are estimating about a 44.5% upside for AL. And I guess anything could happen, but I'd personally be surprised if the stock got that high, because that would put it at an all-time high. Previously, the highest price the stock reached was about $52 per share back in March of last year, and since then it's, had its ups and downs, but overall it's come down in share price to where it's at now, about $38 a share. And looking at the right-hand side, there's no PE ratio listed here, but if we go over to the valuation page, we can see that there is one right here, which is looking pretty good, 6.12, which is 64.25% lower than the sector median and about 15.6% lower than this company's 5-year average. Furthermore, if we scroll down, taking a look at the price to book, this is looking really nice too. It's trading below its book value with a price to book of 0.62, and the price to cash flow is also looking incredibly low, 2.71. So all the valuation metrics on this stock look pretty amazing if you ask me, but the financials are kind of interesting. I mean, they've definitely grown the revenue across the last 10 years. There's no doubt about that, and it has looked a little bit stagnant these last 3 years. But taking a look at the earnings per share, if we scroll down, guys, this has seen a decline over the last few years. Since 2017, this has come down, and in fact, in the trailing 12 months right here, the earnings per share is negative. However, taking a look at the book value per share, this is increasing at quite an aggressive rate across the last 10 years, and like we saw a moment ago with the valuation, AL is currently trading at about 60 cents on the dollar for what its book value is. With that though, guys, as we see here, the net debt is increasing at quite a steady rate, which might just be something that comes with the territory of this company. I need to do some further research, but likely the case is they're financing the purchase of these planes that they then lease out to their customers. And then they're generating income on the difference between the loans they take out to purchase the planes and the leases they have in place, if that makes sense. Now, taking a look at the dividend stats, the yield is pretty average, 2.13%, and they have a negative payout ratio, which is a result of their negative earnings per share, which we just saw. And I'd be lying if I said the 5-year growth rate doesn't knock my socks off. It's just under 20%, and they have a decent dividend growth history of 8 consecutive years. Now, moving on to the third stock of the day, I know a lot of you guys have this in your portfolios. This is Innovative Industrial Properties, ticker symbol IIPR, which is a real estate investment trust that owns specialized properties that they lease out to medical use cannabis operators. And the Wall Street analysts are giving a decent upside on this stock, 41.71%, which puts it at an average price target of just under $162 per share, which honestly I think pales in comparison to where the stock share price has been before. I mean, just this time last year, November 2021, the stock was at about $286 per share, and as this chart is showing us, guys, it's seen a very nice and steady decline since then, coming down to, less than half of that. And right now, as I'm sure you can imagine, the industry that this stock operates in is pretty volatile and therefore is subject to pretty dramatic swings in share price sometimes, as we're seeing from the share price chart here. So really anything can happen. Despite all of this, though, the financials for this company are looking pretty strong, and in that department, they're seeing a lot of growth. Now, the financial history for this company only goes back to 2015, so not very long, but in that period of time, guys, as we can see from this chart, they have grown the revenue tremendously. Now, scrolling down, taking a look at the funds from operation, which is what real estate investment trusts use to pay the dividend, this is seeing some pretty substantial growth as well, and this also holds true on a per share basis if we look at this right here, which is refreshing to see if you're an investor, especially in the face of all of the volatility that tends to surround this industry. Hopefully this trend continues, as investors of this company will benefit from continued dividend payments and dividend growth. Speaking of which, guys, looking at the dividend stats, IIPR has a really high dividend yield right now, 6.5%, and that 5-year growth rate is astronomically high, honestly probably the highest that I've ever seen, 78.25%, with 4 years of consecutive dividend growth. And frankly, guys, when projecting your dividend income in the future from investing in this stock, I wouldn't account for such a high growth rate forever, okay? This is just kind of happening in the meantime. I don't see a near 80% growth rate being sustainable, just full disclosure. And now this brings us to the fourth stock of the day. We're talking about Johnson Outdoors Inc., ticker symbol JOUT, which is a small cap company with a $596 million market cap that makes outdoor recreational products for people who are into fishing, camping, kayaking, and even diving, those sort of things. And look just how nuts this upside is. The analysts are giving it a 134.5% upside, which is crazy, but in all honesty, guys, there's only one analyst covering this stock, and so I guess more than the other 3 we've seen today, we should especially take this one with a grain of salt. And taking a look at the share price performance, in 2020, 2021, the stock saw a pretty aggressive run up in share price, which is very likely due to the pandemic. When all that stuff was going on, a lot of outdoor activities saw a big jump in popularity. Hiking, camping, kayaking. Golf was actually another one that saw a really big jump. But even without the pandemic, this company was already on very solid financial ground, and there's a lot to love in the financial statements. The revenue is growing pretty steadily across the last 10 years, guys, and no surprise, there was a big jump in 2021 last year, which coincides with the run up in share price. And scrolling down, taking a look at the earnings per share, this has grown even more aggressively with an even bigger jump in the earnings per share between 2020 and 2021. And now taking a look at the debt on the balance sheet, this is probably like one of my favorite things about this company. They have negative net debt and have had that across the last 10 years, which is fantastic. And now taking a look at the book value per share, this has increased every year across the last 10 years as well, and it's grown more aggressively pretty much since 2017. The last handful of years have been really good for this company's book value. And now just peeking at the dividend stats, if you're someone who is looking for a high growth dividend stock, this might be a good selection for you. I mean, they have a 5-year growth rate of 26.75% with a pretty average yield just above 2%. And that payout ratio is nice and low, just under 30% with 8 years of consecutive growth. Now, I will admit, while I like a lot of what's going on the financials and here in the dividend stats, I'm a bit on the fence with this company because it seems like it's in such a niche market and it's really one that I know very little about. These are some of the brands they own, and I haven't heard of any of these, but I'd be curious for those of you who are into this stuff to know if you're familiar with any of these brands, so let me know in the comments below. Otherwise, it looks like a pretty well-run business and doesn't appear like it's at the risk of going under anytime soon. Speaking of well-run businesses, the stocks in this next video right over here are kind of the complete opposite of that, guys, and are ones that I think every investor needs to avoid at all costs. So click right over here to check them out, and I'll see you in the next one.